Everybody, welcome to the morning market briefing Tuesday, August 23rd, 2022. Tough day in the market yesterday. Lots going on. Ben, what were the major stories that you felt like impacted the market and all the red we saw?
I think yesterday was kind of what we had talked about in the morning call in terms of I think a lot of the hedges were falling off, and I think a lot of people were getting concerned about Jackson Hole. We'll talk a little bit about that later today. But I think today we're starting to see some of the fundamental impacts of what's been going on in China. For example, the economy continues to soften despite a government push to pump more credit into the system. What they're doing in China right now is the Chinese government is saying to the banks, you have to lend out more money so that we can stimulate this economy. But the problem is the banks aren't seeing any demand for these loans. So what some of these banks are doing is that they're actually extending loans to companies and saying, we'll lend you this money and then we'll let you just put it back on deposit at our bank and we'll pay you the same amount of interest. So it's a wash for you, and then we're okay with the Chinese government. So that's what some of these banks are doing. Other banks are borrowing from each other through short-term financing arrangements, and these can be dressed up to look like their loans. So basically, they're trying to meet this Chinese government state quota, and there's just not any real demand there. So they're grossing up their balance sheets, but there's not really any economic output. The Chinese renminbi has weakened. It's down to about as low as it's been since the pandemic. And then in Europe too, we had Eurozone PMIs this morning, which is just for countries that use the euro. The manufacturing actually came in a little bit stronger than expected, about in line with last month, but services part of the economy really fell back. It's almost in recessionary territory right now. The overall composite is in recessionary territory. It fell to 49.2 from 49.9. It drove a weaker euro. The euro is now 99 cents. So get your euros on sale. Currently, it's 0.9926 to be specific. And a lot of this is due to weaker, higher expectations of inflation in Europe. And as a result, you're seeing higher interest rates. That's slowing the economy. The German 10-year has risen 36 basis points in the last 5 days. That's a remarkable move, especially when you're talking about a 10-year that's only 1.33%. So you're talking about potentially a 30% increase in borrowing costs in 5 days. Now, I get that that's, a little bit faulty math to say that you're going from 0.97% to 1.33%, and that's a 30% increase in borrowing costs. But it's a valid point. And I think the concern is that inflation is not going away, and inflation will get worse. We'll talk a little bit about this later, but you got natural gas prices that are the equivalent of $700 per megawatt hour. In the US, that's $70 per megawatt hour. So they're dealing with energy costs that are 10 times what they are in the US, and they have less capacity to absorb those. So they're in a really bad position. On top of that, you have everyone concerned about Jackson Hole on Friday. Tom can talk a little bit about that, but it seems like hedge funds are really betting that this is going to be a hawkish Fed.
Yeah, Tom, talk to us about what you're seeing and what you're expecting out of Jackson Hole. I know we talked about this a little bit yesterday, but as we start to see actual investment managers position, what's kind of standing out? What do you think they're thinking?
So it's funny because we were standing in the kitchen yesterday and we had Bloomberg on, and they had that headline scroll on the right hand side.
Double time.
And it must have been so important that they put it up twice. But the headline was saying that hedge funds were getting very short treasuries and bonds in general heading into Jackson Hole. And that headline popped up twice in a row. So it took up like half the screen. So it must have been so important that they wanted to mention it twice in a row. But that's what we're seeing. We're seeing a tripling of short contracts on the SOFR, which is the standardized overnight funds rate, which has kind of replaced LIBOR, though LIBOR still exists and it's not really used as much as LIBOR even now. They've tried to kind of replace it, but it's still sort of a new index in terms of short-term rates. And so basically SOFR moves in lockstep with the Fed raising rates. And so people know that a raise is coming. They think that the Fed is going to get exceptionally hawkish. And so they're starting to short this rate, basically knowing that that's going to happen. But what that does is that puts pressure all along the curve, which is essentially everyone thinks rates are going higher. And so those bets are getting heavier and heavier, and that's pushing rates higher. Additionally, we're seeing rates just really spike in Europe. We've seen a big move on the German 10-year. It's risen 36 basis points just in the last 5 days. We always talk about how we're really tethered to the lower end rates across the globe. Well, the US 10-year has moved up 22 basis points in the last 5 days. We've seen a massive sell-off along the curve in bonds. And so I think the expectation is set that the Fed is going to be hawkish. The only question now is that baked in? Are people so short on all these different rates and sold off so much on the 10-year that when the Fed comes out and is hawkish, is it going to have an additional effect, or is it just going to be already baked in? And so that's sort of what we'll see towards the end of this week, is that has the selling already occurred in anticipation, or is this just the beginning of the selling? We're going to get a little bit more of a negative pop on rates when things actually come down the pike.
Do you think there's a buying opportunity now because everyone's so short going into it?
I think so. I think we're ultimately overbought on bonds. I was pretty hesitant to be aggressive buying bonds for the last couple of weeks because it just seemed like this was all an illusion. There was no reason to believe that the Fed was not going to continue to hike rates. And so now we've seen a big move. I think there's a lot of opportunity. We need to be picking up bonds for those who've had redemptions, and we have a lot of redemptions over the next couple of weeks because we're on the corner of the year. The question is, are we going to go all the way back up to like a 347 on the 10-year like we saw earlier this year, which was the high point? Are we going to kind of float up into the 310 range? People are going to say, hey, this is a great opportunity again, and we'll pop back down. And if we get another lower CPI rate print in next month, it could possibly come back to reality. But we'll see what happens. I mean, it could just as easily go much higher if there's a resurgence in inflation.
What about mortgage rates? If you're in the market for a mortgage, do you hit it now at 5.9, or do you wait for it to go back down to the low fives?
I'd probably be avoiding it if I had the opportunity to. Obviously, not everybody has that luxury, but we're towards the high end of the range. We're probably 40 basis points off the high of the year for mortgages. So I think that, we'll definitely be looking to see if perhaps there's some mortgages that we could acquire for portfolios here over the next couple of weeks, because they are very cheap, historically speaking.
Yeah, I think the mortgage thing is interesting. I continue to believe that we're going to see some stabilization. We saw such a quick ramp up and then a bit of a decline, and we're kind of ramping back up again. I tend to think those are going to fall, maybe not, in the next month, but in general, I think there's going to be a better time to lock that in over the next 6 to 12 months.
Yeah. So buying now is a good opportunity for buying mortgages, but for maybe getting one, maybe not so much.
Energy markets. The Saudis continue to seem to be siding with Russia. They are alluding to cutting production, noting that the paper and physical markets have become increasingly more disconnected. Ben, are you surprised by kind of the positioning of the Saudi energy principles?
Not really. They were more or less alluding to this after they met with President Biden at the beginning of August, and then subsequently decided to do pretty much nothing in terms of increasing production. So they were clearly more influenced by what Vladimir Putin wants at this point in time than what the Western economies want. And I think that's not a surprise. What is a surprise is that they're taking such forceful rhetoric right now in terms of alluding to cutting production. Basically saying there's too much volatility, this manipulation of the market in terms of the SPR releases is not healthy, and OPEC is going to adjust if need be. So, I think that energy is actually a very interesting hedge in portfolios right now. We have done a lot of research on energy stocks that should be resilient. Over the last really year, we've put some extra energy into that space.
Ooh,
Fun.
nice.
And really it's as a hedge against if energy becomes a bigger portion of the economy as the rest of the economy shrinks and people have to pay up, how do we continue to benefit? So that's a piece of the portfolio. It's not the entirety of the portfolio.
We're continuing to see interesting fundamentals flow through. Manufacturing slowing a bit in August, natural gas prices coming high. Ben, I think a high level question people wonder, not only here but also abroad, is just what turns this? What could break this cycle of malaise? We were on a call with a client the other day yesterday that commented he'd like to just hear a lot more bad news so that he would feel optimistic about the market. How much more bad news is there?
Yeah, so the positive is that consumption actually has stabilized a little bit coming into August, but the manufacturing side of the economy has deteriorated after a little bit of a pickup in July. So That'll have to be something to watch. The primary reason for this is the high input cost, and there really isn't a way to have that be priced into the market because it's a commodity. So it's purely supply and demand. So you're not basically preloading bad news into the commodity market. It is what it is. And the problem is the commodities costs continue to increase. Natural gas just hit $10, the highest price in the US for the first time since 2008. In Germany, of course, 10 times as much as we're paying. And part of this is influenced by the hot summer that's boosted electricity demand. Part of this is due to increased demand for LNG, and part of it's also lower, just modest increases in production here in the United States. So we got to figure something out, but it seems like these higher prices are here for some time. I think that they might be a little bit inflated due to the hot summer, but nevertheless, I think this is going to be a big cost for companies and going to continue to just feed the beast in terms of inflation.
Interesting story with Apple. They're trying to close the production gap between China and India. Typically, India begins manufacturing new iPhones 6 to 9 months before China. This year, Apple's seeking to shorten that time frame to 2 months. So they're trying to really ramp this up and become, in a way, less dependent on China. Seems like a solid move in light of everything that we've seen over the last couple of years, and not even China specific, just supply chain challenges. The more you can diversify and create parity, the better off you're going to be. How big of a story do you think this is for Apple?
I think it's decent. I mean, it should boost numbers for the December quarter and also for the March quarter, especially for the March quarter, I would say. I think that it could mean there's more volatility in the Apple results in terms of seasonality. You'll have a really big December quarter, really big March quarter, and then fairly soft in the summertime. But I think that it will help to front load things for Apple. I think that it's going to make the supply issues very challenging for them. If I were them, I'd just keep the current cadence, but maybe they're seeing a lot of off market kind of secondary market demand that's distorting the market, and they can capitalize on that. So I think that's probably the thinking, but in terms of efficiency, it doesn't seem like this is the most efficient process. I would prefer them to spread it out over a period of time, because that way you can spread out your manufacturing, and everyone knows that if you run at 80% capacity for 4 quarters, that's a lot better than running at 100% for 2 quarters and 50% for 2 quarters.
Interestingly, of all the companies that I did not expect to be up in this earnings cycle, Macys up about 2% on their earnings. Their downgrade on EPS was lower, was less of a hit than expected. Perhaps inventory came in lower than expected. Ben, is this just the case of the bar being set low enough that they were able to actually clear it?
Yeah, for all the concern about apparel, it seems like apparel's actually held up fairly well. Inventory is only up 7% year over year. Again, we're talking about Target inventory being up 35% year over year. So Macy's inventory is up much, much more. However, they did bring down earnings guidance for the full year due to inflation, but the earnings cut was only 10%. Again, contrast that with Target, which has cut their estimates by over 50% for the year. So interesting and positive results from Macy's. It'll be interesting to see where we go from here, but I'm encouraged by the inventory numbers, and it seems like they're actually executing fairly well.
Interesting day for earnings tomorrow. We got a couple companies reporting. NVIDIA, Autodesk, which we own in portfolios, Salesforce, as well as Toll Brothers. Ben, what are you looking for from those companies? Anything stand out? Any key name to watch?
Salesforce brought down its guidance last quarter. So did NVIDIA, actually. NVIDIA brought down its guidance just a couple weeks ago, but they will guide for next quarter, and I expect gaming to be exceptionally weak. However, so does the market. So I wouldn't be surprised to see NVIDIA even rally on a bad report. Autodesk will be interesting to see. Reasonable valuation, actually, for a software company. They do provide enterprise software, and that's one of the places that we want to emphasize. And then Toll Brothers, who knows that's going to be. I think that they'll probably talk a little bit about the market stabilizing, but continue to be weak and hunkering down. So that's my base case for how those companies come in over the next 36 hours. We'll see what happens. But again, it all feeds through to what happens on Friday with the Jackson Hole report.
Yep, absolutely. All right, we're going to wrap it up there. We'll see you guys tomorrow at 8:30.